All right, so good afternoon and welcome. My name is David Callblack. I'm a partner in the corporate group at Goodmans, and it is my pleasure to moderate today's panel on IPOs. Companies considering going public need to understand not only the process, but the advantages and key business and legal drivers for successful offering. Today, we'll be discussing the Dye Durham IPO in particular as an excellent example of the benefits of going public. This past July, Dye Durham closed its initial public offering, raising $170 million, including the full exercise of its over-allotment option. Following its IPO in September, Dye Durham acquired Property Information Exchange Limited, a United Kingdom-based company that offers cloud-based real estate due diligence products for over $50 million. Closed a concurrent $50 million private placement and closed a new $165 million credit facility. And just last week, Dye Durham completed a $200 million bought deal. So this has all occurred in just 5 months in the midst of a global pandemic, which is pretty impressive. So I'd like to welcome and briefly introduce our panel members who will be sharing their insights into the IPO process and who all happen to have been involved in the Dye Durham IPO. So we have Matt Proud, is Dye Durham's Chief Executive Officer. Matt has been instrumental in the company's growth since 2013 and clearly has a never-ending supply of energy. Next, we have Mike Lozon, the Managing Director, Head of Technology at Canaccord Genuity, who led Dye Durham's IPO syndicate. Danny Lipkin is the Director of Global Development at TMX Group, on whose exchange the company is listed. And last but not least, we have Bill Gorman, partner here at Goodmans, who specializes in IPOs, and along with myself and the rest of the Goodmans team, acted for Dye Durham on its IPO. So before we get started, we have a couple housekeeping matters. At the bottom of your screen, you'll see a chat icon and a Q&A icon. Please use the Q&A box to submit questions for the panel. And we invite you to submit questions during the session, and we will do our best to answer them as we go. The chat icon will allow you to share comments with the broader audience and panel and chat amongst yourselves. If you'd like your comments to be seen by everyone, select the All Panelists and Attendee button from the top of the drop-down menu in the To field. So with that, let's dive in. So Matt, let's start with you. So although the past 5 months have been incredibly busy and impressive for Dye Durham, the process really started long before you filed your preliminary prospectus at the end of June. Since you acquired One Move in June 2013, and before the IPO was completed, you completed over 14 acquisitions and really transformed that company from a regional e-conveyance software company to a cross-border legal technology business. Can you give us a bit of the history from your perspective and give us a bit of the thinking behind the decision to pursue an IPO?
Yeah, thanks, David, for the introduction, and happy to give you some thoughts on what we were thinking as a company. You're right, we did 14 acquisitions prior to going public, and we integrated those businesses to create the larger global company we have today. We did really well as a private company in using our balance sheet and accessing capital that allowed us to scale the business to where it was at the point of the IPO. However, we acknowledged that we'd reached a point where we needed to scale. We needed a cheaper access to capital, and easier access to capital if we wanted to keep doing deals at the velocity that we wanted to do. And I believe we demonstrated since going public that we can do. And an IPO and going public on the TSX made sense to us for those reasons. And since going public, I think you've seen our ability to access those markets, get that cheaper cost of capital. So for us, it's been a great experience so far to date.
That's great. And Mike, are those the typical drivers for going public for companies? Is it really cheaper access to capital? Or are there other elements that can come into play for companies making that decision?
Yeah, there are a number of reasons why companies typically go public, but certainly access to a new form of capital is high on the list. So in Dye Durham's case, as Matt described, a lot of success in the private markets using debt capital. But as they got bigger and bigger and looked to do larger acquisitions, there's a limit on which that debt capital is available. In other cases, it may be as simple as private investors have a certain investing window and they're 5 or 7 years into a company and they're now looking for liquidity versus to put more money into the company. But one way or the other, usually a driver in the shareholder or capital base of the company is one of them. There are other reasons as well. Profile is often a big one, whether that's to help attract new customers, acquisition targets, partners, other things of that nature. And then probably the third would be an acquisition currency, to have a publicly traded stock out there that you can use to entice acquisition targets, number one, and also to incentivize your employees through a stock option plan.
And Matt, actually just following up on that, have you found a benefit from the profile side after going public? Do people know the Dye Durham name, the brand, a little bit more than they did before?
Absolutely. Our M&A pipeline is more robust than it's ever been. Part of that is due to us internally, pushing things and taking things through the pipeline. But there's absolutely an element of people knowing, hey, this is what Dye Durham does. We're a consolidator. We're buying businesses in our space. So that publicity that surrounds the IPO has absolutely helped us.
That's great. And then apart from your decision to pursue the IPO, Matt, what steps did you have to take to prepare the company and really yourself as well to go public?
You can't wake up one day and be a public company. So we got ready starting a couple of years ago. We brought in a board that had independent directors on it, and we started behaving like a public company, reporting like a public company, having the cadences of a public company. So for us, not a lot changed when we actually went public because we were already doing it. We did spend time getting to know investors before the IPO, and I think that helped building trust. So we came to market, people said, hey, these guys have a track record, and they were ready to invest.
Gotcha. And Mike and Danny, you guys are engaged with companies at that pre-IPO stage all the time. What are the main kind of hurdles, considerations that you would point out to those companies as they move towards an IPO?
Yeah, I think that Matt kind of had the correct sentence there. You don't just wake up one day and state, I'm going to be a public company. It takes some prep work overall. There's some internal controls, governance, getting the right management team that can be a public company. That takes some time and discipline. And, we want companies to start preparing as soon as possible. And it just helps, even if they continue to stay private, that still helps from a running a business perspective of having that discipline of being a public company, being able to get financial statements out in a orderly fashion, maybe to your existing private investors, or maybe bringing on some more people who will help with the controls of financial reporting. It doesn't hurt to start preparing sooner rather than later, because that just allows you to get better prepared. And, at the same time, we always say you're running a business at the end of the day. And this is part of running the business, is preparing to go public. You don't necessarily want it to be the entire management time spending on just going public. They still need to run the business. So the sooner rather than the better, that will help smooth the IPO process out eventually down the line, because you put the systems in place that you're ready once you are public.
Yeah, and the one thing I'd add to that and sort of emphasize also is, yes, it's certainly the internal controls to be able to turn your quarters, but it's the predictability and understanding how your quarters are going to come out, so that when you become a public company and you're looking to speak with investors and give them a sense of the variability of your business, that how well it can do in good times, how poor it can do in tougher times, the more that you start to do that cadence as a private company and realize, okay, what's the bear and bull scenario, the more you get used to that, and then you can appropriately describe that to investors. And I think that's something that just takes time. You have to go through it, and you have to sort of practice in a private context and see how well you do, and then that helps you when you ultimately interact with public investors.
And Bill, what about on the legal side, apart from kind of the management side, getting your reporting up to snuff? What is it on the legal side that you would tell companies to keep in mind as they move towards an IPO?
Well, I think consistent with the theme we're hearing from the other, with everyone else on the panel, it's really the key to the process is preparation. And from a legal perspective, we're looking to get, there's really kind of three baskets, I would say, to prepare a company for an IPO. One are financial disclosure. That tends to be the most significant issue we deal with companies going public. In Dye Durham's case, they had been very acquisitive leading up to the IPO, acquired 14 companies over the past number of years. And in some cases, those acquisitions trigger financial disclosure requirements. So not only for Dye Durham itself, but also potentially for acquisitions. The general requirement is 3 years of audited financial history for the business going public. So Dye Durham plus acquisitions completed during that period. So that is often, a very tricky, a tricky one to navigate. And it's really important to address it early in the process. Make sure we have accountants retained, we identify the financial statements required, and get that process started early, because it can be a pretty significant lead time item to have done before you're able to file a prospectus. And I also mentioned, another big one that, Matt mentioned, that they had actually started acting like a public company in advance of the IPO. And that's another area that we as legal counsel work with our clients to help them prepare. Things like board composition. As a public company, you require independent directors, and there's audit committee requirements, all those things. There's a whole new governance regime that will apply as a public company, setting up committees, setting up policies, insider trading, disclosure, whistleblower. So there's a whole governance regime that will help you, that our clients going public establish. And we typically want to address that early on as well, and get it, at least get the framework in place before we file a prospectus and sort of become public with our deal. And then the third bucket I'd mention is the one that people see, and that's the prospectus disclosure, the description of the business. We'll work with someone like Mike and the underwriters to come up with a marketing plan, and it's really important that disclosure around the marketing be crisp and very pointed. And we'll spend a lot of time leading up to filing a prospectus, working with other members of the working group to really refine that. An important consideration often as well is the sort of forward-looking forecast information that the underwriters want to use to market the deal. So, we often will work with the team to come up with measures that we think will maximize the marketing angle, but also that the company is comfortable with living with and is supportable. And there's also, rules that we have to follow in terms of the periods we can forecast information, the types of information. So those are kind of the three big areas. But again, it's preparation up front to get ready to go public.
So Mike, on the preparation point, at what point do you start actually working with companies, and when do you feel that they should reach out to you and start working towards that IPO, putting the marketing materials together and kind of getting a sense of what the story is before you lead up to the roadshow?
Yeah, I mean, you can do it relatively quickly, i.e. within 90 days if you need to. But I think the question, which is the more salient one, is how long should you? I would say 6 months at least. More often a year is kind of when we start, at least loosely, and then work our way up to ultimately hitting the markets. Because a lot of that comes back to my earlier comment, is everyone getting their head around how the business is evolving. Whether it's a high organic growth or there's acquisitions, there are many things coming together often. And you need to think about the best way to position that in the market. And I think one takeaway in Dye Durham is a great example. Is every business is different, and we toyed with different ways of describing the business and focusing on the acquisition side, the organic growth, other elements? What was the right way that resonated best with investors, and most importantly, was an accurate representation of what the company really did and what differentiated them? And I think that sometimes one IPO can be very successful and can be completely different from the next in terms of how you position two companies that are both software companies in what might appear to be the same space.
And Matt, what was your experience with that, kind of looking at your company through the marketing lens and analyzing it in a way you probably hadn't really needed to analyze it in before?
Yeah, no, it's a fascinating experience, and it really makes you stop and think and try to tell your story in a very crisp and direct, accurate way. I think it's very important, from what my takeaway is very important for CEOs to be involved in this process. This is something they really should take ownership of. We're the ones telling the story. We're the ones asking people to invest in our company. So it's very important that we have a very good understanding of the story and how we deliver it to achieve credibility and ultimately get people comfortable with investing in our companies.
Yeah, that makes sense. So Mike and Danny, as when you look at Dye Durham, what was it about that company that made it, in your mind, an attractive candidate to go public from the TSX side and then also from an underwriter side?
Yeah, I mean, to Matt and Mike's point of being a really crisp company, I would suggest to everybody go on SEDAR, take a look at their deck and look at how they message that story overall from a financial historical perspective to the acquisitions, and show that this was a very strong management team that knows what they're doing, that they had successfully executed in the past, had a lot of opportunities go public. And to Mike and Matt's points of the reasons of going public to further acquisitions and further continue to grow, it was really articulated well in that deck. And that's what people saw and people understood, and what we saw too, to know that this is the right type of profile of a company to go public. Matt also had prepared years in advance, so we knew that they were ready as a management team for being public. Mike was mentioning you can get ready in 90 days. It's possible. It's going to be a lot of late nights and all of your weekends. It can get done, but if you start preparing that year earlier, a window opened up and maybe you want to go sooner, that'd be a lot easier than just hitting the ground and trying to do it in 90 days. So what we say is that preparedness that Matt and team really took on, the executing on the business itself, and that is paramount to any successful IPO, is just how is the business done historically? They're a good, strong management team with a good, sound business plan, and looking what is going public, the reasons for that. And in Matt's case, I think a lot of that just continued to accelerate the growth of the company. That really came through with the IPO itself. And I think that investors clearly saw the great company that Matt and team had built and wanted to invest in the company. So I'd really suggest, pull up the deck for everybody on SEDAR, really understand that story and how they articulated that to the investors overall.
Yeah, and I would say in terms of what, when I first met Matt and the team, what attracted me and our team to the business. I mean, the metrics speak for themselves, frankly. It's a very high growth company, very high margin. What's not to like about the metrics? I would say the interesting part is it still, even despite that, it took us a little while to craft the story in the best possible light. And so even, and again, look at D&D's metrics, they're amazing. But you still need to be able to explain to people what is your differentiation and what makes D&D really good at what they do. And I think Matt always knew it. It was just a matter of, making sure you're not focusing on, investors may take you in one direction down a path that's just the wrong path to understand this company. And so I think that's, you start with the metrics, but then you morph that into, okay, why does this company have such great metrics? Why are these metrics so sustainable? Why are they going to continue to grow? And that why is a little bit of the trick of explaining it to investors, because they'll, check that they're there, but I need to understand that they're going to continue to be there and they're going to grow and they're going to improve. And I think that's that's kind of taking the metrics and putting it into the qualitative side.
Yeah, and it's interesting talking about this now and thinking back, months and months ago, about 20 people sitting around a boardroom on a Sunday, talking about this very subject and how you're going to create put this together in a way that's going to resonate with your investors. So if we do kind of turn back to that IPO process, Matt, we filed the preliminary prospectus on June 29th. You got Canada Day right around the corner. The summer is not a time when people generally go to market, let alone launch an IPO. And then on top of that, we're just coming out of a lockdown. So I think a lot of people probably, when you filed your preliminary prospectus, are thinking, what is this guy thinking? Can you give us a little bit of insight about your mindset, kind of approaching the launch and approaching it despite all of these, kind of adversities to an extent?
Yeah, well, I think first and foremost, we just talked. We were ready. We've been prepping and planning for a long time. I think secondly, our business performed very well through COVID, and we knew where we wanted to get to. And at that time, we felt it was right to take the public market. So I think those were just the two fundamental things that for our business made a lot of sense. But it was interesting. I believe we were Canada's first virtual IPO roadshow. And it was an interesting experience. The days were very busy. You'd start at sort of 7 o'clock in the morning with, I believe it was British investors, and you'd end up on the West Coast at 6 o'clock at night, and they'd pack you in there. But people took to the story. It worked. We were able to effectively deliver our message virtually. And because it was right for our company at that time, the message was clear, the ask was precise. Investors were very keen to invest.
Yeah, and I can't overemphasize that enough, because I think that brings the whole, the discussion up till now all together. It's the preparation side. Had we not done what we had done, there's no way we could have turned everything around so quickly. And obviously there's no way we could have predicted that we were going to, have COVID and be in the depths and then pop back as quickly as we did. But that's the markets. You never know what they're going to do. And when a window presented itself, we were able to hit it very quickly. And, in hindsight, hey, it's been a great window ever since, but who knew? It could have been a several week or month window, and we wanted to be ready to take advantage of it. And so again, I just think that speaks to all of the preparation, because once you're ready, to Danny's point, you can speed things up very quickly. What you can't do is the inverse.
And then in addition to the preparation, the preparation really is de-risking. Were there any other kind of steps that in this instance that you were taking or that could be taken to de-risk the IPO to allow you to get, to get off the ground quickly and close quickly?
So, we did do test the waters before the IPO to talk to investors, make sure there's appetite for our investment in our company as a public company, and we did that over time. Again, we spoke to people for a long time before we wanted to go public, making sure that there was interest in our story, and that gave us confidence that we were ready to go, that there'd be appetite for and demand to buy Dye Durham. So I think it worked very well in our case, in particular.
And Dave, I just mentioned as well that on the legal side, we did the confidential prospectus filing, which again was, I think, very effective to help de-risk the IPO. It basically, what a confidential filing does, it allows you to file your preliminary prospectus in advance of actually publicly filing it. And so you can actually go through a review process upfront with the Canadian Securities Commissions and address comments and revise your disclosure, so that when you're actually ready to go to market and make a public filing, basically you've hopefully addressed all material comments on the disclosure. And in Dye Durham's case, we did that process. It's a relatively new process that we've used we use it on Dye Durham, and we had actually used it previous to that on some other offerings. And eventually the OSC came out with rules that actually allow this. And so at the time we decided to file, we had the advantage of knowing that our regulatory review process should be very efficient. We'd also been into the TSX, and we had started our application process with them in advance. So they were up to speed. And effectively what it allowed us to do was reduce the period from publicly filing the prelim to actual pricing and closing by, I'm going to say 3 to 5 weeks, which, in a public markets deal, an IPO, is a significant reduction in the time, that you're at risk, at market risk. We were in the middle of a pandemic and no one, was sure what was going to happen or where things were going to go. And so to be able to move very quickly and knowing that we had that ability, I think also gave us the comfort to file when we did and to move as quickly as we did. We basically filed on the 29th and on prelim, ran the marketing roadshow immediately after that, or after Canada Day, and then went final in sort of mid-July. It was roughly 2 weeks, just over 2 weeks, which is, incredibly fast to clear our prospectus with the regulators.
Yeah, and I think to put an even finer point on that, COVID hit. We had we been on file with a public document when COVID hit, then the market is fully aware of what we may or may not be doing. I mean, there's no more telling example than what we've lived through in this year as to why confidential filings can make sense, because the market window can be gone in a split second and can come back very quickly as well. So I think if this year has proved nothing else, it's the merits of that confidential filing, because in this case, from the market's perspective, we were out there when we were out there, and at the same time in the background, we were able to advance all the things confidentially.
Yeah, and I think, Mike, this ties to, and one of the questions from an attendee on the virtual roadshow process, I think this kind of all ties together. I mean, you used to fly around, the world with your clients to do marketing. It would take about, from my experience, about 2 weeks. You talk about how the pandemic changed that, and this, I think, the confidential pre-filing really kind of works together with the change to the marketing process. But do you mind just talking about the shift from in-person marketing to virtual marketing?
Yeah, I mean, it's amazing. Would be the way that I'd start. I mean, I think of all the things that will not revert back to the old version, this is at the very top of the list. It takes a week process that, as you described, Dave. Often it would stretch out to 3 weeks, especially if you were including Europe, which we were in this case, as part of that marketing, and simply logistics of getting a management team from the West Coast to the East Coast to to the UK and back. And so, the old process was overnight flights, lots of airports, hotels, up and down elevators, security in New York, you name it. And it's a very stressful process, to be perfectly honest, where, we as bankers are kind of dragging management teams around, and you have to cut meetings off so that you can, get up and down elevators into another meeting. Whereas, and so as a result, those meetings are actually not that efficient. They're slotted for an hour. Often, if you get a half hour, you're lucky because of the logistics of just getting people seated in a room and through security, et cetera. In the Zoom case, you start on the hour every time. You're typically done at the, let's say 1:45. If a meeting goes long, maybe it approaches the hour, and then you start the next one. Yes, it's a draining process for management teams, bankers a little bit, but at the end of the day, you go home to your family and you sleep in your own bed, versus get on a red eye, or get on a night flight across the East Coast and so on. And it's just it's just incredibly efficient and cost. I mean, you're taking tens, probably hundreds of thousands, at least $100,000 down to the cost of a Zoom feed for a week. I don't know, $1,000. Like it's dramatically different. So it's and I think it's better for companies. It's better for investors. It allows for last minute changes without a lot of disruption. I can't speak enough how much better of a process it is. And we just kind of did it on the fly. This was the first one, but it's amazingly simple. And if we did it, as we're continuing to do them today, they're that much smoother. At the time, every Zoom was a little bit new, but now people are so familiar with it. It's even smoother, the ones we're doing now.
If you perform better too, Mike, you're not sort of, as you say, you're tired, red eye flights, city to city. You're often, you're hiking up elevator stairs, out of breath when you're part of the meeting. It's a much more regimented and smooth process.
And I'd say for the speeding up process, it's really helped on that element in conjunction with the confidential filing bill, to your earlier point, and now having a virtual roadshow, everything you can compress some of those timelines overall to, fasten up some of these windows that Mike was alluding to earlier. And I think, Matt, you made the point, you can talk to the world in one day versus before having, okay, we're just going to concentrate on the London investors, New York, Vancouver. It's like, we'll get everybody done today. It's a long day for management, obviously, but it's a different kind of tiring that allows you to get in front of a global audience every single day for that roadshow.
Yeah, I agree. And most importantly, you get to talk to more investors.
Yeah, I was going to say it really has democratized it for investors, because if you're in Salt Lake City or Austin, Texas, you can't justify a stop on a roadshow to those types of markets. And so what happened typically is you'd be in New York on the way from a meeting to the airport. You'd throw your phone on speaker and try to do a meeting for those type of non-traditional locations. Guess what? It's just not a very effective meeting either for the management team or for the investor. Now, doesn't matter, where you're located, you can get just as much priority. You can get slotted in. You can get, at a convenient time for your time zone, all of that. So, yeah, I think it's and so as a result, what's happened now is roadshows are much more diverse in terms of the location of investors versus just the core cities.
And Bill, not to belabor this point, but this really does emphasize the importance on the regulatory side of that confidential pre-filing. It seems like, what everybody's saying, if it's going faster, you really need to be more prepared and try to advance that as much as possible.
Yeah, I mean, that's right, Dave. Like, the traditional timeline for an IPO would budget, at the minimum 5 weeks for a regulatory review. We've done some faster, but if you were putting together a timeline, you'd probably say 5 weeks minimum, and it can go up to 7 or 8 weeks. In this type of marketing, you could be done marketing in a week. And the worst thing that can happen, you get, marketing's done, you have a book of orders, and you're in a position to price your IPO, and you have to wait to clear regulatory comments. And that additional time is just adding risk to your deal. The risk that the markets change, the risk that something happens in the world that scares investors and the markets drop. It's a huge risk on an IPO, and to have that out there after you've done your marketing is really something. It's just we avoid at all costs. And so by doing the confidential filing, it really does facilitate this process, and as we said earlier, de-risk the IPO.
Yeah, and I have to wonder, and Danny, Bill, Dave, you guys may have points of view. I have to wonder if some of those timelines may ultimately get pushed to be tightened up in terms of OSC review and so on, because a roadshow used to be 2 to 3 weeks anyways, so there was no reason to do it any faster, because that's how long it took to get investor demand. Now 3 weeks is basically maybe 5 or 6 days, big compressed days, but you can get the same number of meetings in. So I'm interested to see where that goes, but I wouldn't be surprised if over time that that gets tightened, which compresses the whole IPO timeline as well. The confidential filing helps that, but even the core components.
Yeah, and the other thing it's done is it actually reduces costs on the legal side, because in the traditional IPO we would often file an amended and restated prospectus after filing prelim, and then that would trigger the marketing period. So that's the sort of 3 weeks Mike's referring to. Here where basically we can cut out that second filing and just do a prelim and a final.
And Danny, how's the TSX reacting to that from putting your regulatory hat on, in a sense? Is there pressure on the TSX to react more quickly to listing applications in a virtual environment?
Yeah, I mean, what we're always trying to do, and work with the team at Goodman, getting files cleared, in a timely manner too. So the confidential filing allowing us to start looking at the business and reviewing prospectuses. Something on our end that we review is, personal information forms. So clearing officers, directors, significant shareholders of the companies. We work with legal counsel always to get a lot of those hurdles out of the way as soon as possible, so that when you're compressing that timeline, some of those just necessary items that need to be done on our end are clear. And then it's just waiting for that kind of final prospectus, the final financial statements that, that might not be able to get in until the last second. That's just the last step. The virtual world, helps too, that we can, get engaged more quickly, jump on more virtual calls with companies in a timely order, and that it's easier to schedule things too. I think that's what's also been part of the reasoning of why everything's going a bit more smoothly is just, Mike, you're talking about scheduling in-person meetings. Really, like a lot of what was happening was in-person meetings that's now being done virtually, that we can get on the phone right away, get into a virtual call, and understand, if we have questions that we need to ask of the company, just to quickly get on and chat about them overall and get a better understanding. So I think it's really helped the review process overall. The confidential filing and our ability to review early on is getting helped out quite a bit as well. And I think that, people are understanding, let's clear hurdles sooner rather than later, especially because of this. Okay, we only have 4 days of marketing needed on the file. So let's be ready as soon as possible, because we want to, be listed within 3 weeks of that becoming public. That's obviously been a huge change from our end, and just making sure that we've reviewed the company, a lot sooner than we normally would have through the confidential filing.
And this all ties back to that organizational topic that we talked about earlier, about really getting ahead of this, and from the company underwriter's legal side, being prepared to make all of this happen and really in short order when that window opens. So Bill mentioned, closing your book at the end of marketing. Mike and Matt, do you mind just giving everybody a sense of what that, what he's referring to on how you kind of tie marketing together and close your IPO from the investor perspective?
Sure, I can start, and Matt can jump in, as we were both a big part of this on his deal. So basically how it works is you launch an IPO with the public filing of the prospectus, and at that point, press release, and at that point the books are open, meaning any investor can put an order in from that point until the end of the roadshow when we close the books. And typically that's, kind of the last day of the roadshow or the day after. And the way it works is, as those orders come in and the book builds, then that gives you a sense of where you're going to be able to price the deal, the size of the deal, if you're going to be able to upsize it. In the case of Dye Durham, we did upsize it twice actually throughout the roadshow. We got to a certain demand point where we were comfortable upsizing it once, and then to a further demand point where we were comfortable upsizing it again. And so basically that's just, that's a list of orders. Every investor says, hey, I want $5 million, $10 million, $20 million, whatever it may be. You add it all up, and that creates the book of demand. That's the institutional side. And then there's the retail side, where all the brokers from the various banks and boutiques put their orders in, and that's sort of a separate bucket of demand. And then at the end of it, you sit down with the company, Matt in this case, and go through it and effectively choose your shareholders. How much, you only have so much stock to give out. How much do you want to give to each investor, and why? And there's a whole slew of reasons as to that process. Relationship, who is the fund, what's their style, what's their size, all those kinds of things. So that's the basics, but Matt, I don't know what else you want to add to that.
No, I think this is a very important part of the process. I think, if not one of the most important parts. I think one of the things that we at Dye Durham did very well is we built a good, book and a good list of world-class shareholders. So I can give any advice to any CEO looking to go public. Be actively involved in this process. I mean, historically, it's often sort of fall to someone else, often a CFO to do. But look, this is your company. This is your shareholders. You need to know who they are going forward. And as you've seen in Dye Durham's case, look how supportive they can be down the road as you look to go back and raise money. So I would recommend to every CEO to take an active role in picking who your shareholders are. Be very vocal about it with the underwriters and get the shareholders you want. It's your company. Try to get world-class shareholders in there.
Yeah, and I think just to underscore Matt's point that he alluded to there, when we did the two follow-on financings, but specifically the first one, it was only 2.5 months post the IPO, the stock had tripled. And so you might say to yourself, well, geez, that's a big win for shareholders. Maybe they've sold out. Maybe, they're kind of on to the next thing. In fact, the buyers of that second deal across the board were if you take the 10 largest shareholders, give or take, from the IPO, those are the shareholders who participated in the second financing. And so even though it was at triple the price in 2 months, they were back to support the company. And if you get it right, that's what you want. People might trim their position a little bit and so on. That's natural, that's life. But what you want is supportive shareholders so that when you come back and you have, in this case, a great acquisition that you're looking to fund, they're there to support you. And so it's really important from that perspective.
So Mike, we have a question here that's actually just for you. Just when you're working towards closing your book, pricing, what are the considerations that you put in actually pricing the stock for an IPO? What, are you doing it to try to get a lift after close, or, what are the elements that you're thinking about when you're working with the company to price?
Yeah, so there are a lot of elements. It's not one variable. It's a multivariable equation. But I'd say the things you think about are probably first and foremost, what's the demand profile out there? How many investors and what quality of investors are interested in the company at the price range that you've originally chose? That's number one. Then, and then it's really a mix of what deal size do you want? How far do you want to push deal size versus price? Yes, you want all investors to make money. There's no doubt about that. And that's, again, back to the example of investors buying more at triple the price. In part, that's because they have made money and they're happy. But you need to balance that with the dilution to the company, and and at what price is there too much dilution, and if you feel there is, then you go to a higher price where you sort of hit that equilibrium. You don't want to go too far, because what's a bad outcome for everyone is raising money and then having the stock trade off because you priced it too high. So it's I wouldn't say you don't really reverse engineer it for a pop. It's great if that happens, but it's more around putting those factors together and trying to come up with the best mix.
And is there kind of a demand to book size that you think is a good ratio to have when you're actually sizing the deal?
Yeah, I mean, I see over in one of the chats that talks about 3 to 5 times covered. That's not a bad barometer, where to the point where you can start thinking about moving either deal size or price. That's give or take, that's a reasonable barometer. I mean, in this case, Matt, I think we were 13 times oversubscribed. So when you get into that zone, and that's, we did up it twice, and that's a big part of it. If you're kind of one times covered or 2 times covered, I would say that's good, and you're done, and you got your deal done, but that's not really enough to start moving the variables.
I think one thing I think it's important for folks to keep in mind, anyone thinking about an IPO, you're not selling your company, you're recapitalizing it. So you don't need to take every dollar off the table, and you don't need to price for perfection. It's okay for the investors to make a little money day one. It's more of an art than a science, but I'd implore everyone to keep that in mind.
Yeah, and I think, and not to date myself, but the last wave of Canadian IPOs was kind of that 2006, 2007 timeframe when a bunch of companies in the tech space went public. And I would say in that time frame, the mantra was more to price it to perfection of, hey, if the comp's traded X, I want to price right on top of it. And what happened is a lot of those companies didn't have great outcomes as public companies. Sure, they raised 40 or 50 million dollars and then often, dwindled for the rest of their public existence. So I think that mentality has changed. It's been that way in the US for quite a while. I think in Canada, people have taken the mentality that Matt just described, which is, hey, I want to get a great deal for my company, yes, but I also need to leave some money on the table. And perversely, it might seem I'm more likely to trade to a premium if I price at a little bit of a discount because investors are happy and are going to buy more, and that's how you drive there versus versus pricing higher and then not having anything left.
That's interesting. So kind of moving to post IPO, I mean, at the beginning of the session, we mentioned how busy Dye Durham's been over the last 5 months. Matt, can you give the listeners a sense of the difference between operating a private company and a public company?
Look, for us, there wasn't a lot of difference. As I said, we had internally behaved like a public company for a long time before going public. Given the nature of our business, we are capital allocators. That's what we do. So we spend a lot of time in front of investors. In our case, as a private company, it was often lenders, but nevertheless, we were always in front of the capital markets. So not a lot changed for us. A lot of folks should keep in mind, people that are thinking going public, you probably have a capital partner in there already, whether it's venture capital, whether it's private equity. In many cases, the reporting they ask for can be more onerous and less prescriptive because it changes often than you get in the public market. So for us, the consistent reporting, being the same every time, being ready to report that way, having our controls in place, it was a pretty easy transition.
So I guess Mike and Danny, Matt and Dye Durham seem to, they've really prepared well and they were in a good place. And as Matt mentioned, already reporting, on a regular schedule in a public company manner. Not every company is obviously like that. What have you seen from companies and what are some of the struggles that they've faced in making that transition from a private company to a public company?
Yeah, I would say often the biggest one is, Matt described that he as a CEO spent a lot of his time in front of capital providers. A lot of CEOs don't do that. Maybe the CFO takes that role. Maybe no one takes that role because you've been more product focused and the company's been all about building a great product and then selling it, not so much raising cap. Maybe you've had the luxury of being, profitable out of the gate and haven't had, been able to bootstrap or just raise a little bit of friends and family money. So I'd say that's the biggest thing is, especially for product, we're in the software space. A lot of CEOs are product focused founders, engineering types. Those types typically aren't used to dealing with finance types, all day. And so you need to think about that. If that's the kind of CEO you are, how much of that do you want to do versus your CFO or perhaps your COO or president? Every company is a little bit different, but I would say that's a big one. And then the other big one is really just the the internal controls and board and cadence and quarters. I think those are the two that stand out to me.
I was gonna further on Mike's point. So if it's the CEO is the product type, the one who's really focused on, the business itself, making sure then that CFO really's got the public company experience or understands and their team underneath them all the reporting requirements. IR functions might fall on them a bit more, right? They might actually be the one kind of leading quarterly calls, maybe doing more of the investor presentations so that they're more comfortable with it. It doesn't necessarily have to be CEO or CFO who's going to be leading the charge either way, but at least you have that one person who knows how to do it and can do it well. So that at least, investors see a strong management team that has that capability and presents themselves well. A lot of times we do see, maybe bringing in one more person at the management team 6 months, 9 months before you go public, if that's missing from the company overall. So somebody who's had that really executive level experience of running a public company, understands how to do a quarterly call and understanding the messaging and understanding, what's going to be involved in getting that financial team, maybe bringing on one or two more controllers that can help them as a public company. And, we see that a lot of time, about 6 months, 9 months before they go public, of just adding that missing element if that's something that's not there at the executive level.
And then Bill, on the legal side, you alluded to some of this before on the preparatory side of the IPO process, but what after a company goes public do you tend to kind of do to assist your clients with dealing with that transition?
Yeah, I mean, consistent kind of with what Danny and Mike have been explaining, and Matt, Dye Durham, I think there's a range of level of support that we generally are providing to our clients after they've closed their IPOs. Dye Durham's case, I think they are a bit unique in that they have I think Matt's experience in the capital markets, but also Dye Durham's general counsel, Charlie McCready, was very experienced with public markets and very comfortable with public disclosure and dealing with sort of public company issues. And I think that really helped Dye Durham position itself in the public markets and deal with the ongoing reporting, et cetera, that comes after you go public. In other cases, and I'd say more typically, our clients don't have that level of sort of public company experience internally. And so we do tend to work fairly closely with, it's usually the CFO and general counsel, sometimes the CEO, but to deal with the ongoing reporting after the IPO. And, there is a fair bit to get through. And it's sort of like anything, the first time you go through it, it's a fair bit of work. But after you've gone through it once, so usually, 1 year after going public, we would stop, we would not be as involved generally in filings, et cetera. And the companies start to take on more and more of that internally. But, things like holding an annual meeting and preparing the disclosure for that, filing your annual information form, preparing your quarterly statements and annual statements, all those things, are generally new to our clients, and we will work closely with them to kind of take them through those in that first year after going public.
Mike, there's a question from the audience here that I think hopefully you can provide a short response for, but it's really the difference between an RTO and an IPO and what some of the pros and cons are. It's not completely on topic today, but I thought, this might be, maybe you can give kind of a 2-minute overview of your thoughts on that.
Sure. No, and it's a fair question because certainly lots of companies, wrestle with that issue, what's best for them. So I would, at the highest level, I would describe it this way. The RTO process is quicker in terms of being able to get to investors faster and understand where a demand profile is for your company. And that's because effectively the regulatory process comes at the end versus at an IPO where the regulatory process comes at the front. The overall timeline is basically the same, call it 3 months, but the order is switched. And so what's attractive about an RTO is just that, is you can put together a PowerPoint, you can meet investors, you can, have a sense of where demand is and even close a book on that basis quickly. The downside, and it's a pretty big one, is that there's a less deep pool of investors for RTOs. The reason for that is because the time between the time between when you commit your capital to when the stock trades, A, is long and B, is uncertain. So it's at least 2 months. It can be 3 or 4. And so, investors will price a discount into that or just won't participate on that basis, number one. And number two, because you don't have the disclosure, certain investors either full out will not or prefer not to invest in RTOs because, again, all they can really rely on is effectively a PowerPoint versus a prospectus and the diligence that goes with it. So, but having said that, there have been, we've done a number of RTOs that have been successful, and some that have had really, really big strong demand profiles. So it's, there's no perfect answer. And it also depends on the size of your company. There is, the first question, maybe to wrap it in, there are costs associated with an IPO. There's no doubt about that. There's upfront, legal, accounting, filing fees, all that kind of stuff that are, hundreds of thousands of dollars. And so I would say especially for a very small company, you want to think long and hard to make sure that you're ready and you're going to get the benefit of that. And so for that kind of company, an RTO might make more sense. But with my primary hat on, which is dealing with investors and getting investor interest, an IPO is definitely better. But again, there's timing and cost trade-offs to be made, and and every situation is a little bit different. The one other thing, I guess, just on cost to throw in, the US, there are costs here, but just to put it in perspective, the costs of Canada versus the cost of US are, a small fraction. And even, we're doing a NASDAQ IPO today for Docebo, which is another Goodmans company. That's, your D&O insurance alone increases millions of dollars annually. So Canada is, great. And even an IPO is relatively cost effective, but an RTO is even less.
Perfect. Thank you. We got a couple more minutes left. I think, Matt, just to kind of end this portion of it, what advice would you give to a company today that's looking to go public based on your experience from July?
I think it starts off with what I said at the beginning: be ready and have clear messaging. It's very important that the investors know exactly what they're investing in and they're comfortable giving you money because that's what you're asking for. So be ready and have a clear story.
And Mike, Danny, or Bill, any additional thoughts on that?
Dave, I just, to echo the preparation. The worst thing that can happen in an IPO is you run into an issue after you've filed a public document and you maybe started marketing. From a legal perspective, it's really important to address all of those legal issues up front, preferably before you file a public document, and put the company in the best position to succeed.
Yeah.
Yeah.
I was going to say, just have that prospectus drafted and ready so that you're ready to go when the time comes, that you really want to speed up that go public process overall.
Yeah, and seek advice would be my other thing, whether it's legal, bankers, Danny, talk to people to get a sense of, is your company in the right spot to be going public? Is it achievable? Is it going to achieve the result that you think? Sometimes we find companies that do a whole bunch of internal work. Here's where we are and here's what we're going to do. And they haven't really sought advice from people who do this. And you end up spending a lot of time and money, and maybe you're not ready yet. It's a free conversation with any one of us on the line to get a point of view and talk to multiple people, talk to lots of lawyers, bankers, get different points of view. I think that's helpful so that this is a tough process, so that when you go down it, you have a good sense that you're going to get the benefit.
Yeah, that's a great way to end it. So thank you everyone who took part in this. Special thanks to Matt, Mike, and Danny. We really appreciate you guys taking the time today. And then for those members of the audience who have questions that were not addressed, I know that there were some that were left, and apologies for that. Or if you simply wish to reach out, as Mike mentioned, please don't hesitate to contact any member of the panel. We'll be sending out contact details after the session. And then finally, in the chat, you will see 2 links: a feedback survey. We'd love to hear from you about today's session and any topics you'd like us to cover in the future, and proof of attendance and LSO reporting. So thank you, everyone, again. We really appreciate it.
Thank you.
Thanks, everyone.
Thanks.